Welcome to the daily update, where I'll go over the action in the market from Monday, September 15th, and we'll see how things look for Tuesday, September 16th. All right, set another new all-time high with the S&P. Now, last Friday we set one with the NASDAQ and NASDAQ 100, but we did not with the S&P. We actually closed down a little bit. On Monday, all three set new all-time highs again. It's mainly the mega caps that are really driving things right now because we're seeing some weakness continuing to build internally in the S&P. Now, we've got the Fed coming up with their big announcement. One thing to be aware of is to buy the rumor, sell the news when things tend to go up and then the news hits and we see prices fall. Not saying that's what's going to happen, just be aware that something like that could happen because it's pretty much a done deal that the Fed's going to come in and cut rates a quarter of a percent. And then the market's pretty much factoring in that they're going to cut rates again in October. So we'll just have to see if there's some kind of a surprise, not so much what they're going to do, but what they're going to say, not only with their statement, but with the press conference afterwards as well. In the meantime, though, we had more mega cap stocks actually showing some strength, a lot of news hitting those individual companies, but we're back to below average with volume. There's a bit of a wait and see mode as we're seeing things come out. We also have retail sales coming out in Tuesday's session, so that can quite often have an impact. All right, so right at the open, we had a gap higher. Now, the pivot points for Monday were pretty close to each other because Friday's session was not all that wide, and then we had Monday's session, which is not all that wide. That's going to make the pivot points for Tuesday not very far apart either. So it didn't take too much to get back above R2 here, or at least above R2, because we got back up to the 6,600 level on Friday, and that acted as overhead resistance. Well, now we're above that level. So that's another psychological round number that the market is dealing with, and we so far have been able to hold above that. But we pretty much moved sideways after the open, but we stayed above R2. We didn't see a lot of selling into strength. And we later in the day we saw a little bit of more weakness. We chopped above and below R2, but then by the time we closed, we were above R2. We were up 0.47% on below average volume, so that's dropping back a little bit there. We're positive on all three time frames, short, intermediate, and long term. We are getting kind of far away from the 20 and the 50 period moving averages, as measured by the boom indicator that I'll show later on. Interest rates came down a little bit, and at least for right now this could change at any time, but the market's really not fixated on inflation. We had PPI and CPI come out last week, not really raising any red flags necessarily, and the market's pretty much fixated on the Fed coming in and cutting rates. Now, looking at some comments though, we set all-time highs with the S&P, NASDAQ, and NASDAQ 100. Mega caps had that's really what drove things. You'll see that later on. And now we're still looking like we have positive conviction in the short term. When we see positive conviction, we see this list: Stochc RSI, Williams percent R, the CCI charts, and the stochastics. They're all extreme positive. That's showing more positive short-term conviction. But as I said, we're getting a little far away from the 20 period moving average, and we're still looking rather extreme with the RSI 9. The boom and the RSI, those aren't always on the list, where if we're just going up and showing good conviction, these other indicators are usually on this list. Intermediate term, we're still up on the +3 channel with the standard deviations chart. The Sean trend meter is still extreme. The money flow is extreme. And now for 3 days, we've been above the upper Bollinger Band. That's what the percent B measures. And that usually doesn't last very long. Now, it can be an adjustment where price comes down, or given enough time, the band itself will go up, or some kind of a combination of the two. And we're also far away from the 50 period moving average as measured by the boom indicator. And we're keeping an eye on this 200-day simple moving average chart. We're over 10% away from the 200-day simple moving average. Now, there's no hard and fast rule saying, uh-oh, here we need to freak out right now, because we can get 11, 12, 13, 14%. It's just something that we're keeping an eye on for right now, and then we watch for other charts to say, okay, we're hitting resistance or we're really overbought or something happens. And that's when, in the past, over the last couple of years, when we've seen more of a significant decline. So this is pretty much just being watched right now, and I'll point that out when I get to the chart. No real change to the overall Fed scenario. It's not that they're necessarily concerned about inflation right now. It's more of the weakness that we've been seeing lately in the employment situation. But it does look like they're going to cut rates at the meeting. The market's pretty much figured that is going to happen. And then they're going to cut them again at the end of October. The dollar was down, interest rates were down. We have really been dropping with the 10-year yield. We're at 4.03%. Now, we did hit that 4% last week, but that is acting as support right now, and we've been bouncing up off of that. Now, we were higher. We were at 4.06% after Friday. We're coming back down a little bit. So, is that 4% area? Are we going to be able to drop below that? Or is that acting as support and ultimately we will go up with the 10-year yield? That's what we'll be watching for. Sentiment is positive, not extreme though. Here we are setting all-time highs. And even after Friday, we were still neutral. We ticked up from 54, which is neutral, to 58, which is positive. But that could suggest that there's more room to run to the upside. You have a lot of people that think the market should be going down right now, and it's not. And that's why sentiment is lagging a little bit. And this could be to the market's favor, meaning that we could still go up from here before sentiment does become extreme. And we are positive as far as our trend. We're strengthening. We're above the moving average, and we're above 20 with the short, intermediate, and even the weekly chart, which is the long term. So, but actually, that's not true. The weekly chart is still below 20, but we are positive with the green line above the red line. But we are seeing a strengthening trend in the short and intermediate term. With the up day, the bias is positive and the momentum is positive. That's the last 2, 3, 4, 5 days taken together. All right, we just had the Empire State Manufacturing Survey, weaker than expected, minus 8.7. They thought it would come in at 3. Last time it was at 11.9. And this is the only chart to show where we were seeing some general improvement over the summer, and now we're seeing this actually declining. But that's more regional. It's still important, but it doesn't have the impact of other economic reports that we see. Okay, bunch of Isabel Net blog charts here to show you S&P performance after 30% rallies in 5 months. That's pretty much where we've come up now. What do things look like going forward since we were 5 months off of those April lows here? And it's good moving out, but the further you go out, the better the percentage of gains or the percent that were actually higher and the higher those actual returns are. So strength tends to build into more strength. And Goldman Sachs top-down forecast, since we're going up, they are also revising what they see the S&P doing. They see it now getting 12 months from now up to 6,900. They're also revising the earnings for the S&P, and that's ultimately what drives stock prices either up or down. And the fact that this is going up is taken as positive. Then the overall equities allocation, still most here with the commodity trading advisors are net long with stocks. Might be getting a little long here, but we could go higher than where we're at right now. Discretionary versus systematic. The systematic approach tends to work better when we're trending up, where the discretionary approach tries to time the market differently, and that tends to underperform when we've been moving up. But discretionary says, well, I don't know if I trust this. I may sit out right now. And so that tends to underperform. That's the green line here, where the blue line has actually been outperforming. You'll notice, though, when we were really going down at other times in the bear market in 2022, and even earlier here in 2025, where the blue line tends to go down faster. So the discretionary type approach holds up better when we're going down, but it tends to underperform when we're going up. Then earnings per share is now rising in almost all U.S. sectors. So that's looking pretty solid here. This is a 3-month moving average looking at the earnings of the 11 sectors that make up the S&P. But we're also overvalued, and we get this chart at least once a week, if not two or three times a week, where the S&P is now coming in at 23. That's above that 20 level, so that's considered to be expensive. And these are the three stronger areas of the market with discretionary tech and industrials. They're actually more expensive than the general market, where we still have staples and communication, and you could put materials in there. Those are expensive, but they're less expensive than the S&P, and then the other areas that are getting closer down to the more fairly priced area. And this large, this large a disconnect, that's interesting, between rallying equities and weak sentiment. That's really what we've been seeing here is that I pointed this out in Friday's video and I talked about it over the weekend. We're going up with the S&P, but you've got individual investors who are turning more bearish on things. And that could also work to the advantage of the market because it's like at some point folks are going to say, wait, we're going up here. I need to jump in. I have a fear of missing out and I don't want to leave those gains on the table. So that's one way that this could really work here. But looking at this, it's very unusual. Usually sentiment and stock prices, or at least index prices, tend to go along with each other. And it last seen notably in 2023 around the misguided fears of a liquidity drain after the debt ceiling resolution. Okay. All right. But yeah, sentiment has been coming down while prices have been going up, which should be you could look at it as negative, meaning that individual investors are more negative. Okay, fine. All right. But then you could also use this in a contrarian manner, saying, wait a minute, prices are going up and they're bearish. At some point they're going to turn bullish again, and that could support the market going higher. Then looking at charts from a different source, recession risks. Now, the other charts that I see is not really confirming this, but we just look at it anyway from Mark Zandi here. There is an uncomfortably high 48% probability that the US economy will suffer a recession in the next 12 months. It's less than 50%, but historically the probability has never gotten this high. Okay, I'm not really seeing this here. The other charts that we look at are not necessarily confirming this. Now we'll keep an eye on those charts and see if they do start to confirm that. But this is kind of an outlier based on what I've seen. Then early cycle signs. This is actually more positive. Historically, there are classic early cycle signs because a lot of people say, "Are we late in the cycle?" That's usually when we go into a recession. This suggests maybe we're early in another cycle without going into a recession. Businesses see more activity, so they add hours and temps before committing to costly full-time hires. And we're seeing this going up, and that's usually what happens during the early part of an economic cycle. Then foreign inflows, pause this and look at this. We're seeing money actually coming out. So foreign investors are now removing dollar exposure at an unprecedented pace. The dollar is falling because the unhedged flow picture looks very weak. With the Fed about to start cutting rates while most other central banks are on hold, hedging dollar assets will only get cheaper. Okay, so that might mean something to you, but it's kind of a convoluted way of looking at it, in my opinion. And then funding spreads. A further increase in funding spread shows that global macro investors continue to re-risk, kind of contradicting some of the other things that we're seeing here. We see this as a tailwind for stocks over the next coming weeks, just as it was a headwind from January until April when we were actually coming down. Now we're seeing an improvement here. And then earnings. The thing I would take away from this is we're seeing this going up and to the right, and we're seeing this starting, it's coming down a little bit here, but it's ultimately going up here, and that should be taken as positive. And I believe this is put out by FactSet, even though it's Data Trek at the bottom. The charts look a lot the same. All right, so not a real exciting day here. Most of the gain was seen at the gap. We gapped higher at R2. We stayed above R2 in the morning session. Then we started to chop above and below it, only to come back above it going into the close. And not really a big change in the initial overnight session here. We did see the futures coming on a little bit and showing some strength as we worked our way into the open. And we're positive here. Blue line above the red line, they're both, for the most part, going up. It's a little bit choppy right now. But when they're both going up, that's good. We would like to see the blue line above the red line. That means large cap growth is outperforming large cap value intraday. Also, this is showing an improvement as well. Going back to the beginning of September, we were seeing some weakness here. So far, this continues to go up as growth is outperforming value. So we were up almost 1% here with growth, where value was unchanged for the S&P. It was up more for the mid caps, but up less for the small caps. We're still a little bit concerned about this because we started to see a breakout with the small caps, and they're still looking okay here. But as they've been going up, we're seeing the growth to value ratio actually going down, where we're seeing a little bit more of an improvement here with mid cap growth to value. We're back above the 50-day moving average. We're improving, but still below the 50-period moving average with S&P growth to value. We want this to get above the line and continue to go up. And again, not breaking out, but not breaking down either. We're still looking positive with this growth to value ratio. This is looking better. Tesla had a good day on Monday, and that has more of an impact, even though this is an equal weight version of the discretionary sector. But this ratio going up is more positive. You can see how staples have been going down, how discretionary, for the most part, has been going up. Large cap growth, new all-time high here. And this is where the real strength is coming from. The really big stocks that are growth oriented are really driving things. And this going down is also positive. This is value to tech or growth. As this ratio goes down, that's more positive for the market. So here is the short-term trend. We're above the black line here. That's the ADX. We're above the moving average, and the green line is above the red line. One thing to be aware of is this green line is starting to get close to 40. And other times when we got to 40, that didn't necessarily mean a reversal, but it could mean that we slow down at some point. So we want to keep an eye on this. Now, even if we get to 40, there's nothing to say that it can't go above that. It can still go even higher. But recently, though, when we got to this 40 level, that generally had pointed to a point of exhaustion. You can see back here in November 2024 where we hit a really high level and then we fell back, but then ultimately started coming back up. Then we had another high reading here at the end of July, and then we had a pretty big down move right after that, but then we were able to recover that. So it doesn't mean the end of the world necessarily, but it just may mean that price might be due for a decline. And then looking at the intermediate term trend, also positive. We're getting a little close to this dashed line here with the green line, but we are positive. We're above the moving average and we are trending. And then we look at volume. It had been above average, but in Monday's session, it dropped down back to below average. So the weekly sentiment chart here coming down a little bit. It still has us as positive at 72.79, where we had been neutral with the charts that I follow that update many times each day. Now we're starting to drift back up into the red area, which I would call positive. They call greed on this chart. This could be a little bit negative. We're seeing this red line really going up with legal insider transactions. And when we get a real high reading there, that tends to be more bearish for the market. And then the insider buying ETF. There's a lot of folks that really follow insider buying and selling and base their decisions around that. So there's an ETF that follows that. We have been going up really nicely here, even though it did pull back in Monday's session. And then another sentiment gauge here, and this tends to stay more negative for longer. This is Goldman Sachs, still down below the midpoint here and actually coming in at minus zero point 0.9. After it had been improving, it is coming back. This could end up being positive for the market as well. You have a lot of folks that don't really trust what's happening now. And if we keep going up, they're likely to capitulate to the upside and say, oh my gosh, I'm afraid of being left behind. And that's when sentiment starts to get too stretched to the upside. Now, this is a newer chart. It's a little bit tricky to kind of figure out. I ran across this over the weekend by reading a newsletter by Dan Bird, who is now posting this chart in his newsletter and on his website. And I thought, okay, well, let me check this out. If you're familiar with options, there's a lot of Greeks that go along with the options. There's Delta, there's Theta, there's Vega. One of the Greeks are called Gamma. And if you look at Delta by how fast something moves in correspondence to the underlying index, in this case, Well, you look at gamma as acceleration. So you might be going 60 miles an hour, but how long, what kind of acceleration did you need to get to 60 miles an hour? And that's the attempt of what gamma tries to figure out here. Now, after Friday, I was really focusing on this, and I actually did a video that I put on my website. We were we hit that 6600 level because we were seeing a lot of gamma exposure at this level, and then this blue line here, this also tries to measure what the gamma exposure is, and we hit the resistance. Well, now we're above that. So now we're kind of looking up here at the 6650 level. So that, and that's still above where we're at right now. So just to kind of go through this, the gamma flip is 6387, and we're above that. We're at 6615 right now. When this will turn more negative is if we drop below 6387. So this is still taking us positive. And then there's also a thing called a call and a put wall. They're based on gamma exposure across contracts. Okay, the takeaway from this is right down here. The S&P wall is 6,500 to the downside and 6,600 to the upside. Well, we're above 6,600 now. So we'll have to see how this plays out. What the reason I'm using this chart as I look at a lot of areas of support and resistance, and my conclusion is that horizontal lines are more powerful than trend lines. If you got lines that are going up and down, they're not as impactful, in my opinion. Well, another way to try to gauge support and resistance is by using this chart. Now, it's kind of new to me, so I'll just kind of play this out day by day and we'll see. So, if we do really start going up, we're looking at the 6650 level right now to the upside as a potential area of overhead resistance. All right, still looking good here with the VIX, even though it came up on a down day. That's kind of interesting. Usually on an up day, the VIX will go down, but we're still below the moving average with the line chart and the bar chart. We're still wondering if we're going to come into that period of seasonality where we see a real spike in the VIX, meaning that stocks are going down. Now we're getting into the second half of September now, and that's the worst performing half a month for the whole year, going back to 1950. So far, we've been solid for the first half of September. We expected there to be a decline in August that never happened. I started looking for the potential signs of a decline back halfway through July. Didn't see any proof of that in price, but we've seen that happen over the last few years. So we were just watching for it, even though it never materialized. I would rather be aware of something and have it not happen than have something happen and be caught off guard. That's kind of my whole approach with this. And then we are picking up a little bit here above the moving average. We're seeing the volatility of the VIX starting to move just a little bit. Now, I also use an RSI. I use a MACD to measure the momentum and speed of the VIX. That hasn't really picked up yet, but this is coming back up a little bit above the moving average, both with the bar chart and the line chart. And a little bit of a contradiction here. We're declining here with this fear gauge, where we actually ticked up a little bit with this other fear gauge. Usually we see confirmation when they're both moving in the same direction at the same time. And I'm dropping off here with the equity put call daily chart, and we're declining, which is taking us positive on the 5-day chart. And now we're back to declining with the 10-day chart, and that's also taken as positive. We're still going up here with the risk on to risk off ratio. This we were kind of range bound there for a while, and now we're breaking out. That is more positive. That's more the risk on that was alluded to in one of the other charts that I showed a few minutes ago. We're also looking better here with the high beta to low beta. When the market's more positive, high beta will outperform the low beta stocks. High beta stocks tend to be growth stocks, where low beta stocks tend to be more defensive or value stocks. And we're still above the band here, but not really showing a big change with the volatility risk premium, not really getting extreme right now. And this is interesting though. We're still seeing some internal weakness happening in the S&P. We're seeing a drop off in the new highs, even though we're setting new all-time highs with the S&P. We were improving here, but now we're back to going down with the 5-day chart, and we're leveling out here with the 10-day chart internally when we look at the new highs minus the new lows. And in the short term, the advanced decline ratio has actually dropped back down below zero. And on an up day, that's not necessarily what you would expect to see. Now, to break that out a little bit more, the chart that I just showed you, that's this upper area, and we are below zero here. Now, on the positive side, though, when we look at volume, we're still above zero. So we're getting a bit of a mixed picture here. And we're still seeing some mixed signals with other charts that I'll point out as I go through them here. And here, I have another up day, and we've just been chopping around with our advanced decline oscillator. That actually declined further on Monday. And we had an up day, and we're going down with the advanced decline line based on price and volume. Not what you would normally expect to see. Now, this is looking pretty good, though. Accumulation distribution. With the up day, we're going up with the indicator itself above the moving average, and we're above the moving average with the boom indicator. But we're above this red line. We just want to be aware of that. And we were working off of the idea that this was going up. We were seeing a negative divergence here. If this does continue to go up, though, even though it's looking extreme, that would pretty much negate this negative divergence that we had been seeing. And after Friday, we were negative with the Chaikin money flow. We saw the histogram go up, and we're barely turning back up with the red line. So this has turned to positive. But you look at the Chaikin oscillator, it's no longer extreme. It got above this green line. Now it's dropping down below the red line. It's slowing down, but it still hasn't turned back up and crossed back above the moving average. So this smart money indicator is negative. And coming down a little bit with the vortex, still positive with the green line above the red line. And seeing some not real weakness, but not an awful lot of strength. We're still above the moving average with our advanced decline line studies. When we look at the NYSE common stock, bit of a decline with the S&P, but still above the moving average. Where we're seeing a little bit more weakness again are with the mid caps and small caps. They're below the moving average. This is looking good though. We look at the 5 period moving average of the highs and lows across the broad market. This is continuing to go up, and that is positive. But again, we're setting all-time highs here, and we're back to dropping below zero with those stocks in the S&P above their 20-period moving average. And I was pointing out, and I've been pointing out for a while here, we've been going up with the S&P. We've been seeing a series of lower highs here with this particular indicator. That's a negative divergence. Now, again, we could shoot up and come to a high reading, and that would negate this negative divergence, but we're not seeing that yet. And we're also declining with the 50 period, 100 period, and a little bit down here with the 200 period moving average steady. Not what you would expect to see when we're setting an all-time high with the S&P. So here we go. We're looking pretty good. We're above this dashed line here. And the longer we stay above this, if we do start to pull back, the more likely this may provide support. But you can clearly see that we're in an uptrend. We have the 50 period is above the 200, but you go down below here and we did drop to below average with volume. And even with the update, we're dropping with the 20, 50, and 200 period moving average steady. But then we look at the short-term conviction here, and it's still really solid with the Stochk RSI, Williams percent R, CCI 14, and CCI 20 charts. Also on all three time frames here with the stochastics, short term, intermediate short term, and long short term. A little bit of an improvement above the midpoint with the force index. That is positive. Still looking good with the short-term trend here based on 20 periods. Both lines are going up and price is above both lines. And we're still up in the +3 channel with the standard deviations chart. And we're going up above zero here with the balance of power. That is positive. And we're extreme with the CMB composite. I only use this when we get extreme positive or extreme negative. Well, this is the second day now that this has been extreme positive. We are positive with the go, no go, darker blue bars, and still hitting the highest high value here. And the blue line is going up, and that is positive there. We are now on day 94 of this trend that started way back at the beginning of May, according to the Landry Light chart. A little bit further into May, but we're also in an uptrend with a proper order. And we are seeing more confirmation here with the S&P going up, but the TTM squeeze is also going up and actually looking positive. And not really seeing much in the way of ease of movement. We're still just kind of hovering around the zero level there. We had been extreme with the Arun indicator, but now it's starting to drop back. And we're seeing a little bit of a pickup in selling. That's what caused the overall oscillator to drop here. Even though the green line is pegged at the top, that's buyers. The red line, which are sellers, is starting to increase. And we're still negative with the S&P McClellan oscillator. We're below zero and declining, but we're getting a mixed picture here because we're declining with the S&P based on price. We're advancing based on volume. And we look at the NYSE McClellan oscillator, it's still above zero. So it's actually holding up a little bit better. So we're going up with the summation index based on price, trying to turn up after being really choppy with the summation index based on volume for the NYSE. Another mixed picture here, declining with the swing trading oscillator based on price, but still advancing based on volume, which you could take as positive when you see volume actually leading price. And we are turning back and looking more positive with our momentum oscillators. We're crossing back above the moving average of the PMO, but we're declining based on price, and we're just coming back up to the moving average based on volume. So you look internally at the PMOs inside the S&P, we're declining below 50 with the PMOs that are rising. The buy signals are declining, and we're leveling out here and still getting a pretty high reading with the PMOs that are above zero. Positive with the Elder's Impulse system, positive with the Parabolic SAR, positive with the short-term slope oscillator, positive with the MACD. So in the short and intermediate term, we are improving. We're seeing these momentum oscillators turn back up, and ever so slightly with the two long-term oscillators, we're starting to see those improve as well. Copy curve is positive. It's back above its moving average there. And we're declining with the Sean trend meter, but we're still up in this dark green area. That's why it's extreme positive. And the money flow is extreme positive. Ultimate oscillator, even though it declined, is still above 50. We're still above the advanced or the moving average with unbalanced volume. And this is the third day now that we closed outside of the upper Bollinger Band, which can be taken as positive, but this tends to not last for very long before we see some kind of a move in the opposite direction, or the upper Bollinger Band is going to have to go up a lot faster than it's been going up. We're not quite extreme with the intermediate term RSI, but we are extreme with the short term. This is the RSI 9 that I talked about earlier. Positive here with the 10, 20, and 30 period moving average studies, and all the lines are going up and prices above all the lines. Positive with the intermediate term trend. Red line, blue line going up. Red line is above the blue line. That is positive. Above all the moving averages here. This is the distance from the 200-day simple moving average, and this dashed line is right around the 10% level. We're now almost 10.5% above it. And you can see other times when we got far away from it and then became quite overbought, that's when we saw more of a significant decline. That happened back in 2023. We saw it happen twice in 2024, both in April of 2024 and then in July of 2024. Now, it did get up here a few times here, and we didn't see anything too substantial. And it may turn out that this is nothing. We just want to be aware of this. And we're far away from the 20 and the 50 period moving averages. And we're now looking negative with the bullish percent index for the S&P. We were positive. We dropped a little bit. We're back below the moving average. But I use a little bit different context here with the NYSE bullish percent index. It's not really moving all that much. I'm trading this as positive mainly because it's above 50. And the same thing here with the NASDAQ 100 bullish percent index. We're above 50 even though it declined a bit in Monday's session. And this now for the second week, we are above this R1 pivot point. After coming up and hitting this and not being able to close above it for 3 weeks, now we're entering the second week above this point. Can we stay above that? Because this is a weekly chart and it really won't count until we hit Friday's close. At the upper end of the trend channel here, that could be slowing things down, but we've been here now for quite a while. But we're positive with our different ways of looking at the trend. The Heikin Ashi is positive, the Kigi chart is positive, Renko, and three line break. All of those are positive. And longer term, actually coming down a little bit with our 150, but it's still giving us quite a positive reading. And then this is a different way of looking at the 200-day simple moving average. This is not measuring the percent that price is away. It's just measuring the movement of the overall moving average itself. And positive on all time frames across all the different indexes, positive with commodities, and negative with the dollar across the board. And the growth areas are really what outperformed. Communication, tech, discretionary. We have good days when those lead, where we're seeing more of the defensive areas that were down, especially with staples. And we saw everything green here. S&P setting a new all-time high above 6,600. NASDAQ setting a new all-time high, which also now means the NASDAQ 100 as well. they don't have it as part of their predefined alert here. And then Canada set another new all-time high. And so the big green areas here, Google, both Googles, that helps things. Where we were up with Apple, up with Microsoft, that helped tech. Oracle, which is just going to the moon right now, even though it gave back a lot later in the week last week. But when you see a lot of green in these growth areas, that's why things go up. Discretionary, Amazon, and Tesla. Tesla was up over 3.5%. And then the more defensive areas, you're seeing an awful lot of red. So we're seeing the S&P going up with the equal weight actually underperforming. Not a big deal at this point. Now, if we continue to go up with the S&P and this continues to go down, yeah, that'll become kind of a big deal. But a little bit of a disconnect now. That just means the mega caps outperformed. So we're going up a little bit here with our S&P to equal weight ratio. Overall, that means the weighted version is outperforming. This is a similar thing, but kind of flipped upside down, where the equal weight is underperforming the weighted version of the S&P. And we have the Dow. It was virtually unchanged, up just a little bit here, just coming off of recent all-time highs. Neutral with the Elder's Impulse system. Here we're setting new highs above this R1 pivot point with the NASDAQ. That's looking pretty solid. Are we going to give it a run to try to get up to this R2 level? That could be interesting to see. Positive with the Elder's Impulse system for the NASDAQ. Also above this R1 level, will we give a run up here to this R2 pivot point? That is currently acting as overhead resistance because we have never been there before. And this we're positive with the Qs, looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is positive, and we're getting a little further above this trend line going back to 2009 with the weekly chart of the NASDAQ 100. And just kind of chopping around, virtually unchanged here with the S&P 600 small caps, where we were up a little bit stronger. This chart looks a little bit better, a little stronger with the Russell 2000 small caps, but we're still neutral with the small caps. Now, this is based on the no, this is IWM. That's the ETF for the Russell 2000. So this isn't seeing the strength that's getting picked up in the index. Mid caps, they were actually down just a little bit here, so they underperformed. Neutral with the Elder's Impulse system. The Wilshire broad market measure setting another new all-time high, setting a new all-time high with the total U.S. stock ETF, and actually down a little bit, but still above the 50-day moving average with the financial sector. Looking good by itself, but we're continuing to see it underperforming here with the financials to S&P ratio. So we'd like to see that doing better than it's doing. The FANG index, the really big stocks, another new all-time high here. So Apple was up over 1%, and we're generating a golden cross here. Amazon was up almost 1.5% above its 50-day moving average. Microsoft up over 1%, has now got back above its 50-day moving average. And Google is just shooting up here, up almost 4.5%. And that's a real source of strength currently. Above the moving average here with Meta, 50-period moving average, and NVIDIA. Now, there's some China stuff with copyrights and anyway, there's NVIDIA ended up not being all that changed. Where there's good news coming into Google, there's kind of it was bad news for NVIDIA, but it repaired a lot of its losses as the day unfolded. And Tesla, man, look at this, up 3.5%, really shooting out here, just about ready to generate a golden cross. And Netflix was up, but still not quite back up to its 50-day moving average. Semiconductors. Now this is the SMH semiconductor ETF. We look at other semiconductor indexes. They're not hitting all-time highs right now, but this one is. And so that's looking pretty solid there. And then we look at the staples to tech ratio. When this is going down, as it is right now, that is positive. And we're still seeing a bit of a strengthening with the short-term correlation between U.S. and world stocks, as well as the longer-term correlation. And we were up with oil getting back up into the mid 60s, and the dollar is still in a downtrend. Dropping back down, right down here, we got down to this 4% level with the 10-year yield and then bounce back up. Now we're starting to come back down. Are we going to be able to break through that to the downside? And we're back to going up with the 10-year based on price. So looking okay here with the Qs to S&P. We're above the moving average. Discretionary is looking good compared to the S&P. And large cap growth is outperforming large cap value. So we're looking good with the large caps, doing pretty good here with the mid caps. We're not doing all that good here with the small caps. And this ratio is also continuing to decline, the Staples to S&P ratio. When that's going down, that is positive. So what's the outlook then for Tuesday? We're positive on all time frames, and I'm still calling this overhead resistance. We haven't that weekly chart at the 64, 68 level, if I'm getting that right. We haven't been above that for very long right now. And so we need to be there for a while before I'll actually consider this as support. It may act as support, but usually the longer we're above that price, and then if we see a decline, the more likely that is to actually act as support. And we're going to get retail sales. That'll be the big one on Tuesday. Import export prices, industrial production, and capacity utilization, business inventories, and the NAHB housing market index. And then anything geopolitical. There is lots of things going on, but the market doesn't seem to be all that bothered by these other things that are happening right now. And then here is a look at the economic calendar. We will have the big Fed decision at 2 p.m. Eastern on Wednesday. We're going to get initial claims and continuing claims on Thursday. There's no reports coming out on Friday. This is also another look at the economic calendar. Seasonally, though, for September 16th, going back to 2002, really looking pretty positive here across the board. But we are now into options expiration week. But that historically, going back to 1980, has been positive. We've been up more than down. Now, be aware, when we get the week after options expiration, we're down more than up going back to 1980. And we're kind of hitting the end of this positive seasonality that we've been seeing put out by Stock Traders Almanac. We hit it here, maybe bump up a little bit more along the way here. It's the second half of September that tends to really be weak. Now, we thought August was going to be weak, and that ended up not happening. So we just use seasonality as a guide, not to necessarily make decisions. This also shows where September is historically weak, as does this chart. And here is the second half of September, which is the worst half month going back to 1950. Also, weak seasonality that so far has yet to really materialize, and now we're coming into September. This also shows how September is typically weak. So we don't have a long list here, but we have the things that are on this list are kind of influential. The McClellan oscillator and summation index for the S&P, that's negative right now, and the bullish percent index. The reason why they're gold is I count these as primary indicators. We still have a lot of things on the positive side, but we're getting a mixed picture when we look at our smart money indicators. We're looking good with the accumulation distribution and Chaikin money flow, but we're negative with the Chaikin oscillator. Where our longer term growth to value and discretionary to staples ratios. Those are especially discretionary to staples. A little bit of weakness with the growth to value, but they're still positive in the bigger picture. Now, when we look at the McClellan oscillator and summation index for the NYSE, that even though it's not really showing a lot of strength, it hasn't dropped below zero, which is keeping the summation index advancing. And we're mixed with the swollen trading oscillator. I could have easily put that on the negative side. Parabolic SAR, momentum oscillators are positive. And again, I look at these in a little different way. The bullish percent index for the NASDAQ 100 and NYSE are still considered positive. Ease of movement, money flow, and ultimate oscillator are positive. The vortex is positive, and the momentum for the NASDAQ 100 is positive. Financial sector is positive, but we're a little bit concerned. We've been watching it underperform now, pretty much going back to the beginning of the summer months. And the long-term special K chart, not only the daily chart, but the weekly chart is positive. And here are the pivot points for Tuesday's session. Because we didn't see a lot of gyration here in Monday's session, the pivot points are not all that far apart from each other. So our conclusion, we're positive. I'm still calling this overhead resistance, even though we're above it right now. If we see some kind of a decline, is that level going to be able to hold? In the short term, we are seeing more positive conviction. If we do start to fall, we'll be watching the 20 period moving averages. And we are improving, but there are also some weakness areas that we're seeing developing in the intermediate term. And we still continue to be positive in the long term. The one thing that we're watching is on a percentage basis, how far above we get above that 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.